It's that time again. If you're a real estate agent and you're looking to finally build a business that creates consistent cash flow, but you're concerned about all of the market disruptions, relax. You found your safe haven to learn the secret to success. List you last. Welcome to this week's podcast. Hey, welcome, fellow listing agents. Bob Mangold, the listing coach, here with this week's episode of the If You List, You Last podcast. Now, as always, thanks for listening, sharing, and downloading. Now, today's podcast is going to be a little bit shorter than normal because I want to update you on what's going to happen in the interest rate market and what you should be paying attention to in any of the upcoming announcements and reports. So just a quick reminder, make sure you join the Real Estate Asset Advisor Facebook group so you can join in on the conversation, share your thoughts, comments, or questions on any of the topics I discuss right here on the podcast. And as always, you can connect with me at www.homeboss.com or bobmangold.com. So grab a cup of coffee, settle in, and let's get to it. So first, let's start with, I don't have a crystal ball. I can't tell you what's going to happen today, tomorrow in the interest rate market, but I can give you a good idea based on charts, based on a lot of the things that are happening. There's been some pretty big talk in the last 10 days or so that could have a massive impact in a positive way on interest rates. And I think what's important for you to understand as an agent is that all the studies which are based on interest rate fluctuations show that if interest rates drop down into the 5 3/4 range, it's going to unleash a ton of activity in the real estate market. And if it would get down into the 5.5% range, would open up a lot of inventory in the market. And the reason for that is people have been accruing debt at a fairly high rate, accumulate a lot of debt, deleted their savings. And at this point, the amount of interest that they're paying on that credit card debt or their other debt is so extensive that it still makes sense for them to sell their home and buy a bigger home. And I can tell you, you see a big influx in refinance activity right now for exactly that reason. And just understand that, hey, people come in while they may be moving from, say, a 3 or 3.5% interest rate to 6 3/4, 6.5, somewhere in that range. They're still saving $600, $700, $800 a month, even with the higher interest rate, because that credit card debt is sitting there 25 to 35%. And trust me, folks, people are sitting on a lot of credit card debt. If you go to the Facebook page, about a week ago or so, I posted the top 3 cities in the country carrying the most amount of debt. And quite honestly, it was staggering. And so people are struggling underneath that. And the reality of it is now it's been about 2.5 years since you've seen a big jump in the interest rates. And people are now acclimated to understanding, hey, they're not 3% anymore, and they're probably not going to be 3% anymore. The reality of it is I don't see any of that happening. I don't know if that'll ever happen again in my lifetime, to be quite honest with you. Now, there's a lot of market forces that exist that really determine the interest rate. And typically everybody thinks when the Fed announces rate cuts, that has some impact on interest rates, and it has none. Technically, it has none. It may give people a little bit more confidence, but it has nothing to do with it. What actually affects interest rates are mortgage-backed securities. They're mortgage bonds. That's all it is. And if people want, and really it's institutions, it's not the average American buying a mortgage-backed security. It tends to be hedge funds and money managers and things like that. If they want to get a stable rate of return, let's say over 30 years, then they can go out there and do a mortgage-backed security right now and get about 6 3/4, right? So why would somebody want to take and pay less or offer less? The reality of it is what really caused interest rates to spike was the amount of government debt, the amount of government spending, which meant that we went into debt, which means our bonds are riskier, which means they have to pay more money. So the one that's most closely associated with mortgage interest rates and the one that you should watch is the 10-year Treasury. That's the benchmark for when you're going to see mortgage-backed securities move, because that's the main competitor with a mortgage-backed bond versus getting a government bond, okay? Even though you might see the 10-year interest rate go down, doesn't necessarily mean mortgage interest rates are going to go down. And it's the same with the Fed, right? Starting in September last year, the Fed lowered interest rates. On the Fed fund rate is simply the interest rate that banks pay each other to borrow money overnight. That's what the Fed fund rate is. It has nothing to do with mortgages. Okay. But it is still competing for money. Make no mistake about it. And when we went into debt, in order to take and calm the market's nerves, the government started to have to raise what they would pay on a 10-year treasury. That impacted the mortgage-backed security market because now they have to compete for the same money, right? Understand, money is always in competition with itself. Where can I get the highest rate? When you see the stock market just kicking butt, you'll see that the bonds have to raise, you'll see the prices raise because they have to compete with that money. Make sense? So I want you to understand that this government debt is really what created this. The second thing, if you've listened to the podcast for any length of time, you know how I feel about the reports that the government provides us on employment and consumer price index and inflation and everything else. And it's complete and utter BS, right? The jobs numbers is complete BS. If you doubt it, just ask yourself, why did they adjust the third quarter jobs by 818,000, meaning they had 818,000 jobs less? It's the way for the politicians to make it sound good that they're actually doing a good job and they're creating jobs. And they're not. They weren't. And of the jobs that were created, the majority of them were government jobs. It was a way for the last administration to fool people into thinking that the economy was better than what it was. And it's not. And so as you hear more about job cuts and things like that, believe it or not, that's actually better for interest rates because that all impacts inflation. The next thing that you're going to hear is the consumer price index. So as I record this, it's going to be released tomorrow, and it happens every month, so it's not a big deal. Folks, again, that number is so skewed, it's ridiculous. Let me just give you an example, and it's important for you to understand as an agent so you can have intelligent conversations with your clients. Because remember, you're always looking for ways to differentiate yourself, and the number one differentiator is your knowledge. So what's going on right now is you're going to have the core PCI. It's the consumer price index that gets released, the monitor of inflation. So what happens is the housing number accounts for 46% of that number. So when you hear the consumer price index, it went up or it went down, just understand housing makes up almost 50% of that number. Now, the numbers in housing are completely skewed because they're using numbers from 6 months ago when rates may or may not, or rents may or may not have been going up and housing prices may or may not have gone up. But the number one thing driving the housing number is owner's equivalent rent. So you'll hear it as OER. And what that means is they actually call up like 500 people randomly and say, hey, if you could rent your house, how much could you rent it for? Folks, imagine they're just calling the regular consumer, has no idea what rent rates are in their neighborhood or things like that. Just like a Zillow or anything else, or the listing price of a house, there always tends to be overinflated. The OER is overinflated because somebody goes, well, I could rent it for $2,000. When in reality, maybe they could get 12, 13, 1400. Hugely skews the housing number. And when I say usually, it means by 3 to 0.4%. So if tomorrow they release the PCI and it comes in at, let's say, 2.9, just understand if owner's equivalent rent was actually calculated, or I don't understand why there needs to be any reason for it to even be in there, to be quite honest with you. It's a completely made up number, but you actually could be in the 2.5, 2.6 range, maybe 2.4. But the government's target is 2. That gets us so much closer to that. It's ridiculous, which means there can be some easing of the interest rates. So when you see that tomorrow or in the future, just understand that's going to have an impact. But the real reason I wanted to talk about this today is because I want you to pay attention over the next, I don't know, it might be month, might be 6 weeks. If you follow anything in the stock market or the investment market, you'll know that gold is at an all-time high. What does gold have to do with interest rates? Gold is a hedge against inflation. When gold prices rise, they think that inflation is going to go up. So one of the reasons that has a huge impact is that, can governments cut spending? Of course they can, and they need to, and it's happening. But the reality of it is we need to open up assets. And so I want you to pay attention for the term mark to market. And you're going to hear the Treasury Secretary has already said he's open to doing this. What that means is we have gold reserves, however many ounces of it, whatever the government holds. When we went off the gold standard in the mid 70s, the price of gold was about $42. They have never adjusted our inventory in the value of it for the market value of gold, which right now is just short of $3,000. If we do an adjustment on the mark, meaning the $42, we move it up to the market rate of about 2,900, 2,950, whatever it is, the market value of gold today, we would add another $900 billion to the Treasury, almost $1 trillion, by simply accounting for our assets in 2025 dollars, not 1972 dollars. Why we would do it that way, I don't know. Other countries don't do it that way. We do. So think of it this way. It would be like you saying, I can't refinance my house because I bought it at $50,000 in 1972 and it's still only worth $50,000. Wouldn't make any sense, would it? That's what we do with gold. If we take and do a mark to market price adjustment, we would add almost $1 trillion to the Treasury, which means we don't have to sell as many bonds, 10-year Treasury, 2-year Treasuries, 30-year Treasuries. We don't have to sell as many of them, meaning the interest on those, we could pay less interest because we don't need it to fund the government. I know it gets confusing, but if you just think about it, you got an asset that you priced at $42, it's worth $3,000. If you made that adjustment, you have access to a lot more capital than you would have had. Meaning I don't have to sell bonds, which is nothing more than debt. Bonds are used to pay the debt. So the more that we continue to spend and throw away government money, the more bonds they have to sell, which the more bonds they sell means they have to raise the price to get more people to buy them. If you add $1 trillion to our Treasury, you don't have to do that anymore, at least not at that rate anyway. And you'll see interest rates substantially fall quickly. Be paying attention when you hear anything about mark to market on gold and that the Treasury is looking at it or doing it. That would be a huge impact on our interest rates, more so than anything else that the Treasury could do would have an impact on interest rates, like doing a mark to market adjustment. So be paying attention to that because, folks, if we do that, you could see the interest rates. Now you could see that at 5.5. You could even see it at 5.25. If that happens, just be prepared. Now you're going to unleash a lot of activity in the housing market. People have adjusted to the higher rates. They get it. That's the way it is. Again, I don't see us going into the 3 or 4s. It's certainly not in my lifetime. I'll never say never, but I'd been around a long time before they went that low, and I think it's going to be that long again. But if you start hearing the more the government cuts waste, right? I don't care what you feel politically or how you feel about it politically. We can't continue to spend $2, $3, $4 trillion more than we bring in every year. The only way to do that is to cut the spending that we have. If you do, that'll help inflation. It means we don't have to sell as many bonds to pay for it, which means there's more competition for them, which means we can lower the rate. The mark-to-market adjustment on gold would be a huge impact. And what I can tell you, folks, is if you hear that happens, you need to be paying attention and you need to make an adjustment and start calling those past clients, letting them know what's going on with interest rates. Again, will you see competition for housing? You definitely will. But that's going to be the way it is. And until we solve that housing shortage, folks, that's a whole nother problem. But I wanted to give you an update on what's going on with all this activity in the interest rate side of it. It's not stuff that most agents pay attention to. I get it, but it's critical for you to plan your business because if that would happen this year, you're going to have a whole lot better year than you had last year. So I hope that helps. I know it can be a little bit confusing. It's a lot to digest. Listen to this twice, but just be listening for anything that talks about the Treasury doing a mark-to-market adjustment on the price of gold. And trust me, you're going to be happy with interest rates. So hope that helps. I know it's a little bit confusing, but I believe it's important for you as a real estate agent to know and understand how this stuff works. So with that, we'll talk to you next week. And remember, if you list, you last.